Welcome back. Here is a look at shares of Netflix. That company has been in the news this week as the company is approaching a $1 trillion U.S. market cap by 2030, following a major earnings beat earlier in the week. Our next guest is bullish on shares of Netflix. Let's talk to her about that stock and a couple of others as well. Lisa Schreiber is investment analyst at Gradient Investments, and she joins us now. Lisa, thanks a lot for joining us. What is your take on Netflix? It is off its peak, but much more modestly so than many of the other big tech players in the United States. Do you see this stock as somewhat tariff resistant and economic slowdown resistant?
Yeah, absolutely, Paul. We love Netflix. I mean, they just beat on the top and bottom line, and especially their beat on earnings with nearly 17% was very impressive. And also, when we look at yesterday's market, Netflix seems one of the few bright green spots in the market at the moment. And the reason for that is not only the beat on top and bottom line, but what sparked investors' enthusiasm was also the management's commentary that they say that they are probably a little bit more immune to tariffs than other industries, and they do not expect a whole lot of subscription drawdowns in case of economic drawdowns. And we have to see Netflix is one of the largest the largest ones in the streaming business, right? The most famous ones. And when we look at potentially consumers tighten down their purses, Netflix is sure one of the last ones to go here. So we love Netflix. We think it's a very bright spot at the moment. It's high quality. It's the leader in their space, and this is what we favor in this situation at the moment. And
what would your answer be if an investor asks, could I buy, if I have a long-term horizon, is now an appropriate entry point into shares of Netflix? We're looking at the stock. It's priced at just over $1,000 now, U.S., $1,034. And more to the point, it's trading at 39 times expected future earnings.
Yeah, hey, it's not cheap, right? On a next 12-month PE ratio, it's not the cheapest here. But I think the growth prospects for Netflix are really compelling. Again, it's the leader in their space. They're a little bit more immune to tariffs than a lot of other industries, right? And they also have a lot of catalysts on the horizon. They keep on extending their TV shows. They went into live TV. We've had a rough start, but I think it's going well at the moment. They're keep on expanding their offerings here, and also their ads business is picking up here, which is very interesting and a long-term growth prospect for Netflix. So I would say it's absolutely a possibility to look into to invest.
Okay, Amazon is another stock you like. This one is a bit more nuanced when it comes to tariffs. This company, of course, ships products all over the world, but it also has an Amazon Web Services division, which is a completely different line of business. So why do you like Amazon?
Like you said, we have to look a little bit deeper under the hood with Amazon to figure out what the growth prospects here is. They got caught off in the market sell-off lately amid concerns of the tariff impacts in the retail business. But what we have to say here, it's a very diversified business. It's the largest cloud computing company in as well. So it's the leader on both sides. So we get diversification here. I think the market sell-off is a little bit overdone. Because of all the growth potentials in the cloud business here. They are, so history proved that they are very efficient in cost cutting. So when really something is going on with tariffs, and if they hit, they're really well positioned in increasing efficiency. Operating margins are very high, so they could take some hits from the tariff side while their cloud computing business is ever growing. And when we look at the valuation on a next 12-month PE ratio, it's the cheapest it has been in years. So I think this is a great opportunity to jump in here and have a long-term perspective for Amazon.
Amazon now trading at about 27 times expected earnings. Okay, let's go to your third stock. You like this one as well, Palo Alto Networks. It's a security provider, a digital security provider. Why do you like Palo Alto?
Again, the largest cybersecurity company in the world, a leader in their space. And I think you see a theme here, right? We like the leaders in their respective spaces. We like quality because we think they can weather the situation at the moment a little bit better. Same story here with the market sell-off. It got caught off in a market sell-off here, Palo Alto, but we have to look a little bit deeper here. The cybersecurity space is a little bit more immune to tariffs overall, right? Especially if when we look at companies who spend in cybersecurity space, right? If they have to tighten their purses a little bit when it comes to tariffs, cybersecurity spending is probably not on the chopping block first because of rising threats there. AI, they are very diversified in the space as a whole. So we think this is a very compelling space, and it's not the cheapest overall, but again, it's cheaper than it has been in quite a while. So we think it's a great opportunity here as well.
The company reports results in about a month from now, so the results are not imminent. But when the company does report, Lisa, what kind of things would you be looking for in the company's guidance or management commentary?
I would say in the commentary, we would look for what they see with business spending from other industries. I think that could give us a hint about how tariffs might hit other industries. But I think because they're more immune to that, and because they're in such an important space that is ever growing, I think they are well set up for the future, and it should be a good quarter for them.
What kind of stocks are you avoiding right now, Lisa?
Overall, I think more on the discretionary, consumer discretionary side, retail side. I think we need a little bit more clarity here. And earnings season already started, and what investors have to face here is a little bit more uncertainty when it comes to some businesses holding off of giving guidance at all, because they do not know much more than all of us do, right? So they have to hold off until they get a little bit more policy clarity here. So I would say the retail space, some also companies that are involved in building, in housing, in cars. I would be a little bit more cautious here as they're figuring out how all the tariff talks and how all the policy impacts are going forward, are impacting the business.
Lisa, thank you so much for joining us today. It was a good conversation. Lisa Schreiber is an investment analyst at Gradient Investments.